All right, let's just dive right into this explainer and unpack a true masterclass of timeless wisdom distilled directly from the legendary Warren Buffett. Look, whether you're a seasoned investor or literally just starting your career, the principles we're going to cover today go way beyond just picking stocks. They are basically foundational blueprints for making sharper decisions, avoiding catastrophic errors, and ultimately building a truly meaningful life. So we've organized his massive wealth of insights into a cohesive 5-part syllabus for you. We're going to cover the 20-punch card rule, the traits of success, your circle of competence, the price of mistakes, and finally, winning business and life.
Okay, let's kick things off with Section 1, the 20-punch card rule.
Let's start with a foundational mental model that completely changes how you should think about making decisions. Imagine treating your entire financial life like a literal punch card with only 20 slots. That's it, 20 choices for your whole life. If you did that, you'd immediately lose the temptation to constantly dabble. Buffett argues that the gamified ease of modern investing, swiping on an app, just because a stock blinked green yesterday, is a massive trap. You just can't build real wealth by dabbling. But if you knew you only had 20 punches ever, you'd research furiously, you'd wait patiently, and when you finally punch that card, it would be a massive height conviction swing. Honestly, you probably wouldn't even use all 20 punches. And the truth is, you really wouldn't need to.
Moving right along to Section 2, the traits of success.
We spend so much time analyzing companies, right? But how often do we actually analyze the traits that compound into a successful human being? Think about this for a second. Imagine you could pick just one classmate right now and receive 10% of their lifetime earnings. Who are you picking? I mean, you wouldn't just look at who gets the highest grades or who's the star athlete or who has the richest parents. No, you'd evaluate them like an asset. You'd look for a very specific set of self-made qualities in the person you intuitively admire and trust.
Buffett actually evaluates people based on 3 very specific metrics: intelligence, energy, and integrity. But here is the absolute kicker. If someone lacks that third trait, integrity, you actually want them to be dumb and lazy. Seriously. Why? Because if you hire someone who is brilliant and has boundless energy, but they lack a moral compass, they will actively work to ruin you. Integrity is the non-negotiable multiplier. It dictates exactly how those other 2 traits are deployed.
And this brilliant quote perfectly illustrates why you have to consciously build positive habits like honesty and generosity right now, before they solidify into permanent fixtures of who you are. The chains of habit are too light to be felt until they're too heavy to be broken. Buffett often points out that people are basically imprisoned by their habits by the time they hit their 50s or 60s. But right now, you aren't imprisoned by anything. You can literally audit the qualities of the people you admire and proactively adopt them while those chains are still light enough to break.
All right, Section 3, your circle of competence.
So now that we have the mindset down, how do we evaluate actual businesses? The secret here is defining your perimeter. You don't need to predict who's going to win the chaotic, super competitive tech or auto races. You just need to stay within your circle of competence by investing in highly predictable economics, like chewing gum. Think about it. At the dawn of the 20th century, there were roughly 2,000 auto companies. The car completely changed human history, yet almost all of those 2,000 companies went bankrupt. Being right about a massive macro trend changing the world absolutely does not mean you'll like money. Compare that to Wrigley. The internet is definitely not going to change how people chew gum. By sticking to what you predictably understand, you avoid getting crushed by the unknown.
Well, how do we actually value that predictable business once we found it? Buffett jokingly calls Aesop one of the greatest financial pioneers ever, because this ancient proverb from 600 BC, "A bird in the hand is worth 2 in the bush," literally holds the secret to calculating intrinsic value.
If you strip away all that intimidating Wall Street jargon, calculating a company's worth is entirely about estimating the cash it will generate from now until Judgment Day and discounting that back to today's value. It's just laying out cash today to get more cash back later. It really doesn't matter what the stock chart looks like or what the talking heads are screaming about on TV. If you can't confidently answer how many birds are actually in the bush, when exactly are they coming out, and how sure are you of that outcome, then you aren't investing, my friend. You're gambling.
Which brings us to Section 4, the price of mistakes.
Look, even the absolute greatest investors stumble. So examining Buffett's errors is exactly where we learn what to avoid. Early on, he was taught to look for cheap, quantitative bargains. He actually admits that buying Berkshire Hathaway in the first place, originally as a failing textile mill, was a classic cigar butt mistake. He bought it just because it was incredibly cheap. It's like finding a soggy, discarded cigar butt on the street that has just one free puff left in it. The brutal lesson he learned? Time is the enemy of a lousy business and the friend of a wonderful one. With a lousy business, you're constantly putting out fires, and your capital never compounds. It is infinitely better to buy a wonderful business at a fair price than a fair business at a wonderful price.
But here's what's really interesting. His most painful errors don't even show up on a balance sheet. They are the mistakes of omission, those moments where he completely understood the business but just sat on his hands. He doesn't lose sleep over missing early tech stocks because they were outside his circle of competence. But years ago, he understood Fannie Mae perfectly. The price was an absolute steal, and he just sucked his thumb. That hesitation, failing to swing at a fat pitch right in his strike zone, cost his shareholders around $5 billion. Let that sink in. When an incredible opportunity is right there, you have to swing.
And to truly grasp the sheer weight of making a bad move, consider his early $2,000 loss on a Sinclair filling station. Today, that single loss carries a staggering opportunity cost of $6 billion. He bought into that station when he was roughly 20 years old and lost his initial $2,000. But because of the astronomical rate at which he has compounded money over the decades since, that initial $2,000 would literally be worth $6 billion right now. It's a striking, honestly kind of terrifying reminder of the literal cost of early mistakes, which makes that 20 punch card rule we talked about earlier all the more critical.
Finally, we arrive at Section 5, Winning Business and Life.
Ultimately, the math has to serve a human outcome. So we move from the mechanics of investing to the gritty reality of operating a business. People are always wondering how small, local businesses can possibly survive against massive conglomerates with unlimited scale. Well, Buffett's answer is that small businesses beat giants by being nimble and dedicating literally every waking moment to outserving the customer. And there is absolutely no better example of this than Rose Blumkin, affectionately known as Mrs. B.
Mrs. B was a Russian immigrant. She couldn't read or write English, arrived in America with literally just a tag around her neck, learned English from her kindergartner daughter, and saved every single penny she could from selling used clothing. After 16 years of doing this, she finally scraped together $500 to start the Nebraska Furniture Mart.
By relentlessly out-hustling her competitors, treating her customers like family, and selling at fair margins, she grew that single location into a staggering $325 million enterprise. And she did all of this without ever seeing a formal balance sheet. When Buffett eventually bought her business, he didn't even ask for an audit from an accounting firm. He just asked for her word. Her integrity and business acumen were just that absolute. She crushed massive competitors like Sears simply because she thought about her customer from the second she woke up until she closed her eyes at night.
This just brilliantly illustrates the sheer power of unstoppable drive. Mrs. B actually worked on the floor at the store until she was 103 years old. No way around it. You simply cannot institutionalize or replicate that kind of fierce, localized dedication at a massive, bureaucratic corporation. It is the ultimate, untouchable competitive advantage.
And transitioning from accumulating all that wealth to actually allocating it, Buffett views his own immense capitalistic success with profound humility. He sees it as a lucky product of how he was uniquely wired for this very specific modern society. As he points out, if he had been born 5,000 years ago, his ability to allocate capital wouldn't have saved him from being some predator's lunch. He was just lucky to be born in an era where his specific wiring paid off massively. Because of that, he believes the wealth fundamentally belongs back with society, entrusted to intelligent people to solve the world's most intractable problems, the ones that don't have a naturally profitable funding mechanism.
So, as we wrap up this masterclass explainer, considering the habits you're building right now and the focus bets you intend to make, you really have to ask yourself how you will use the limited choices in your own life. You have the power to define your circle of competence, to choose unwavering integrity, and to focus relentlessly on serving others. The punch card is in your hands right now. The only question left is, how many punches do you have left, and where are you going to place the next one?